Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So the other consideration that we're going to make, and the other observation that we're going to make, is really just the idea of support and resistance. So the first observations that we make is the idea of looking at trend identification, and the most easily determined by utilizing your moving averages. And the next is a very simple concept of identifying support and resistance levels. And really, all support and resistance reflects is strength and weakness at certain price levels. The lows are, of course, considered support, and the highs are considered resistance. So here's an example of the AUX, and this is going back, essentially back into in the last year. But I've just taken a snapshot of the price action or the pair value action up until April. And what you'll notice here is that we saw a support level established over an extended period of time at that 98 level. And the way I really try to describe the whole concept of support and resistance is basically looking at it like, and this may not make any sense to people living in southern states or where there's no such thing as ice, but for anybody that has spent any time up north in the northern states, or of course in Canada, we sometimes skate on lakes, or we skate on rivers. And the idea is that when we're looking to see whether or not it's safe for us to go on, what we do is we test it. So we might step, with one of our toes, and we might step on that. And then we might maybe put both our feet on it, and we might take another sort of little bit of a bounce, and so on and so forth. And as we do this, it establishes a strength level for the particular ice. Now, what we have to recognize is that we want to be cautious of that level, because what happens is that level can hold as support, and we could conceivably go out and enjoy the day skating, which would be equivalent to a nice little bounce off of that support level. But what could happen is if that support gives way, ultimately, we're in trouble. Or in the case of the chart, we see a continuation of the downtrend. So the important consideration here is that we want to look at these support levels as areas where essentially the bulls and the bears are more or less fighting it out. It's kind of that line of scrimmage. Now, the more tests of a support level, the higher probability that it's going to hold. But understand that as soon as we get a break below that support level, then the probability is that you're going to see a continuation to the downtrend. And we can see that very clearly here in the AUX charts. In the AUX chart, which of course the U.S. dollar strength against the Australian dollar, that we saw support level actually being tested, but we in fact saw the lows getting lower. This is actually, and we're not going to get into technical patterns, but this in fact is a technical pattern that we would identify as a descending triangle. And the idea is that we have a support level in place, but we just don't see the highs breaking higher, which is the other key ingredient for a change in trend. The other observation, of course, is that we can see, and I'll just erase some of these lines here, but we can see that there's also a resistance level up here as well. And so while we can be very aware of a support, we also have to recognize that if we're trading off of a support level, that our next target sits up at a resistance level. So, for example, you can see this last bounce off of the support at 98 actually yielded a really attractive move up into this 102 zone. But that 102 zone acted as a very strong resistance level, and you can see that there was consolidation on a number of occasions within that range, suggesting that we needed to be cautious. And then, of course, you had a sell-off and then a break below that support, which then yielded a continuation to the downside. So that's one consideration with respect to support. An example of resistance, and I'm sorry the slides here are appearing a little blurry, but here's another snapshot of the U.S. versus the Canadian dollar as seen in the CDD. And again, this was actually taken this morning, and I've removed the moving averages. But what I want you guys to look at here is that you can see over the last several days, we saw resistance at that 98 level, and that suggested to us that, be cautious. We may get a bit of a pullback. The pair does not seem to want to continue higher, and that resistance level actually matches up with a previous resistance level up in here, and we can see that within that range over in here we had as well a support level identified. And so what we can do is we can identify between this 97 and 98 level an area of resistance. And again, that allows us to step back and make some considerations when it comes to identifying some possible trade opportunities. So, for example, what we can do, we're going to look at implementing some strategies to trade a directional bias. If I put that chart up of the Canadian dollar once again, the U.S. versus the Canadian dollar, the CDD. Well, there's a couple of observations that we can actually make. First of all, we can see that back at 95, we saw the moving averages cross over, which lends credibility to a change in direction. We can see that blue was below red for the entire duration here, and very briefly crossed over, but for the most part, the red line was quite well respected. And then we saw a change here in the first or second week of May, that suggested to us that perhaps there was a new trend underway. What we can also identify at this point, and this is sort of opening up some ideas for a possible observations moving forward, is we can see at 98 that there is a resistance level identified, and we're looking at these lows here, and one consideration is that previous support becomes resistance. And so we see support through here, we see resistance here, we see resistance here, and now we're seeing resistance across this level here. And so what we want to ask ourselves is, okay, if the Canadian, or if the U.S. dollar is going to strengthen against the Canadian dollar, what we need to see take place is a break above resistance level. So the path of least resistance right now, based on our moving averages, is to the upside, according to what the moving average is telling us here. We've seen a pullback down towards that 97 level, which is where those moving averages are falling, where that moving average is falling into place. Yet we haven't seen a full crossover, suggesting that still, in the bigger picture, in the grand scheme of things, the trend is to the upside. But we don't want to just necessarily jump in right away. We want to look for a confirmation. Well, that confirmation, if we want to trade a directional view to the upside, is going to be based on a nice, and I'm not suggesting we're going to see this happen in one day, so this might happen over the course of a few days, but what we'd like to see is a nice break above that 97 resistance level. So what we're doing is we're saying, okay, we've got moving averages trending to the upside. That says that there's a possible continuation or trend to the upside, but at the same time, we need to see a break above a resistance level to lend credibility to a continuation. So we can sit back and we can be patient, waiting for that particular move to take place, so not committing any capital until we see that nice green candle break beyond. And then once that takes place, we can step in and we can buy some call options looking for a possible continuation to the upside. So what we've done here is we've just stepped back and we've applied some very simple techniques to the idea of possibly buying call options to trade a directional bias for the U.S. dollar to the upside. Now, the consideration would be that I typically like to buy at-the-money call options when I'm looking at participating in any opportunity, whether it's currencies or equities. And so I might consider buying a 98, a 98.50, or a 99 call option, and then that gives me an at-the-money option contract that I can participate in as the U.S. dollar conceivably continues to strengthen against the Canadian dollar. So I would use this short-term test of the 21-bar moving average to confirm that there is some support down here, and then what I would do is I would use a break higher above a resistance level as a second confirmation to lend credibility to that continuation to the upside. So again, some very simple techniques to create some rules as far as entering into a possible opportunity. Now, the other consideration is that we can look at creating a bull call spread. And we could use our price charts to map out a particular spread strategy as well. So in other words, my considerations would be the exact same as I just went through, whereby we see the moving average cross up. So we want to focus on strategies that allow us to participate to the upside. We recognize that there's a resistance level and that we've seen a pullback, so we don't just want to jump in right away. We want to see whether or not there is support down here at 97. Once we see that nice green candle come into play, we can go in and we can buy our call options. But when we go back and we take a look at the chart, we can see that there's a resistance level up here at the 100 level. Now remember, 100 on these on the pair value charts, as far as the CDD is concerned, represents essentially par. So remember that we multiply the spot market value that we see in our forex trading accounts by 100, and that actually gives us the what we would be looking for on our ISC price charts, or on our ISC pair value charts. And so in this case, what we would be looking for is possibly take advantage of a move between 98 and 100, or 0.9800 in the currency market, to 1.00, which would be par in the currency markets. And by creating a bull call spread, obviously we offset our cost basis, we lower our risk exposure by selling call options at or above that strike price. And so what our consideration would be is that over the next couple of weeks, we may see an appreciation of the CDD towards the upside, but there's a very high probability that it's likely going to hit that 100 to 101 level and then perhaps consolidate or sell off. So our expectation is that over the next little while, we have some limited profit potential. So we're using the price chart to map out an area where it would be an interesting consideration for selling call options. So our expectation is that we're going to buy calls down here at 98, and those calls are going to generate an intrinsic value. And then we're going to see, we're going to sell off these 100 to 101 call options. Those call options are all-time value, and unless the pair is trading above 100 or above the written strike price, then they're going to expire worthless. That lowers our cost basis, lowers our break-even point, gives us creates a strategy where we've had to commit less capital, and we're using our price charts to navigate through the trade itself. Okay. Now, and of course, just a reconfirmation here that we can profit the difference between our strike price that we bought and the strike price that we sold. Now, when it comes to buying put options, this is why I want you guys to keep an open mind here. Recognize that I'm utilizing the exact same chart as I was referencing for purchasing call options. So understand that we're in a little bit of we're at the crossroads here with the CDD, in that this sell-off that we saw today could conceivably be the start of a bigger picture drop. But what we were utilizing to essentially create an entry opportunity to go long call options, we could sit back and we could use the same considerations to perhaps buy some put options with the expectation that the CDD is going to drop in value. So the first thing is that we can see we have a pivot point all the way down here just below 97. Recognize as well that we have our moving averages. So this level here, that 96.5 to 97, acts as support. So we don't want to be buying put options until we see whether or not that support holds. Now, if we go back and we analyze the price chart, we can actually see, if I even just extend that that line a little further, we can see that we have support. That support turned into resistance on a number of occasions, and then once we broke beyond that, we saw it act as support once again. And so it's kind of like testing that thin ice. We want to see whether or not this holds, and we're going to wait, and we're going to wait, and if it holds, well, then we're going to look for buying some call options. But if it breaks, well, then now we have an opportunity to take advantage of a close below that support level, and a possible continuation to the downside. So once we see that close below that key pivot point and that key support level, well, we can step back and we can say now we have our signal to buy some put options, and we can step back and we can use the concept of support and resistance and identify some a price target or a pair value target. So in other words, we might go in, buy put options at the 96.5 strike put level. So by 96.5 strike puts, once we see that pivot point break, and then we can use the 94.5, 95 zone as a key target to manage for profits. Okay, so we're looking at the exact same chart. We're establishing many of the exact same observations, but all that's left to take place is the price chart, is the pair value needs to actually either break higher in the case of the call option selection, or needs to break lower in the case of the put option. So what it does, by analyzing this price chart and applying some of these very simple techniques, is it really allows us to sit back and be patient. So in other words, we're not going to rush into any sort of a trade. We're going to let the market take us in. So once the pair value signals, then we can go in and buy calls, or we can go in and buy puts. There's no sense buying puts right now. If this level is going to hold that support and we get a bounce back up here, because remember, if we buy puts now, what's going to happen if the pair jumps back up to 98 is those puts are going to actually start losing value. Whereas if we get that confirmation, there's a higher probability that the CDD is going to continue to the downside. So that break below that level is going to get us out if we're long calls. It's going to get us in if we want to go long put options. Now, in the case of creating a spread strategy, rather than looking at previous resistance levels, we're going to go in and we're going to look at previous support levels. So again, the rationale that I just went through as far as buying put options is going to be the exact same, where we're going to look at that previous pivot point. We're going to wait to see the break of the pair value below that pivot point. We're going to go in and buy put options. But what we're going to do is we're then going to look and take a look at some key support levels, and we're actually going to sell off puts below that level. And what that does is it creates a spread that allows us to profit between the difference of our strike price, of course, minus the premium we've paid, and the strike price that we've sold. So we're stepping back. Again, we're just applying some very simple techniques to establish an entry point, and then we're using our support and resistance levels to identify either targets or key levels that are appropriate for option writing. If we felt that perhaps there was a greater downside potential for the CDD, then we would go back and look at a bigger time frame and perhaps find a lower support level, conceivably all the way down at this 93 level if the price charts dictate that. So again, keeping it simple, we can apply the very same observations if we want to be an option writer. Now remember, the idea of the option writer is to sell option contracts that have a high probability of expiring worthless. So I think that options writing and understanding the whole concept of support and resistance go hand in hand.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.